Welcome to today's webinar presented by the Florida Retail Federation, where we're going to cover the forgiveness sections of the Paycheck Protection Loan Program. Today, I want to begin with some remarks about the Florida Retail Federation. I'd highly encourage you to go to the frf.org website, where you'll find up-to-date links covering information about the COVID-19 epidemic, in addition to small business resources that will help you through this difficult time. Also, I'd encourage you to look out for daily emails from the Florida Retail Federation surrounding the COVID-19 epidemic and ways that you can help your business continue to survive during this time. I'd like to introduce our speakers for today, two gentlemen from Carr, Riggs & Ingram, the accounting firm, also known as CRI. First, Michael Carter is the partner in charge of the Tallahassee office and is on CRI's internal PPP task force. Michael is a CPA with more than 20 years of experience and is a member of both the American Institute of Certified Public Accountants and the Florida Institute of Certified Public Accountants. In addition, David White is joining us, and he's a tax partner in the Tallahassee office of CRI and actively works with numerous small businesses regarding the tax impacts of the CARES Act. David is a CPA with more than 10 years of experience and is a member of both the American Institute of Certified Public Accountants and the Florida Institute of Certified Public Accountants. Both gentlemen are graduates of the Florida State University. For any questions that you may have for us at the Florida Retail Federation, I'd encourage you to reach out, and here's our contact information. Again, my name is John Stolp, and I serve as the president of the Florida Retail Federation Services, which is the for-profit subsidiary of the Florida Retail Federation. Crystal Lake is our Central Florida representative for the Florida Retail Federation, and all of our contact information can be found here. Now let's begin to talk about the PPP and the forgiveness of the PPP loan. But first, I'd like to just tell you a little bit about CRI. So CRI has been an integral part of the Florida Retail Federation for a few years now as part of our chairman's circle, and has been a big supporter of the retail industry in that respect. CRI has 22 offices across the state of Florida and is a very well-respected firm in the areas of tax and audit, and especially here surrounding the issues concerning the Paycheck Protection Program. Now, some current statistics regarding the PPP program. According to the U.S. Treasury's website, there were over 4 million loans that were processed through various banks across the country, totaling over $500 billion. 7.5% of the total loans from the PPP program originated in the state of Florida, with 9.3% of approved dollars also coming here to the state of Florida with an average loan size of $118,000. Now, one of the important things that I'd like to note here is that the Treasury, U.S. Treasury, has put out an application for forgiveness of your PPP loan, and that was released just a few days ago on their website. There's a link here on this screen that shows you where you can go to get a copy of that. In addition, this will be available on the Florida Retail Federation website. And right now, I'd like to turn it over to Michael Carter, who's going to go in depth and talk about the forgiveness of the Paycheck Protection Program.
For our trucking company, can we include our leases of our trucks? It seems to be that if that is a need to operate, then you can include it. Interest can also include personal property. So if you purchased a truck in your trucking company, the interest on that should be allowable and included in eligible expenses. One more clarification that they did specifically state was you cannot prepay interest amounts. That would mean, if you at the end of the 8-week period, you made next month's interest payment on a loan, they're gonna rule that to be ineligible. It doesn't apply that to any of the other categories. It doesn't specifically say that's the case, that no prepaid amounts for rent or anything like that. However, if they made that stipulation on the interest, you can kind of assume that it applies to the other categories as well. The borrower has 8 weeks. That's when the clock starts ticking is with the receipt of the funds, the loan origination date, and you gather those, accumulate those costs over the 8-week period, those eligible expenses. What the clarification with the application did was, go back. There's been a lot of questions about payroll. Is it on a cash basis? Is it when it's paid, or is it for service time over that 8-week period? How does that work? One clarification that they did make is that you can move that 8-week period from the date that you receive the funds to the first date of your next payroll period, next full payroll period. That way you can coincide your payroll with your payroll period, covered period for the PPP loan. It allows it to line up a little better. One more thing that that the interim guidance said was that the breakdown of the funds has to be 75-25, payroll and non-payroll. The application clarified that the 75% applies to the actual disbursements made during the period, not the loan that you receive, not the proceeds that you receive, but that 75-25 has to be applied to the actual disbursements during the covered period. There was a lot of speculation there that you could take 25% of the proceeds and say that was your limit to be able to spend on non-payroll items, but that's not the case. It's applied to the actual expenses during the covered period. Next slide. More information on the forgiveness and some clarifications. Each employee is limited to $100,000 of compensation on a pro rata basis. But what's unclear about it is how is that $100,000 limitation calculated? Do you calculate that compensation on an annualized basis on the highest individual amount of the payroll that was issued for a payroll period? Is it the average payroll for an individual, or is it annualized based on the cumulative amount paid to that individual over the 8-week period? There's a lot of questions about, can we pay bonuses? Can we pay, give a raise, whatever? All of those questions are pointed to this particular topic because you have to annualize the salary or wages or compensation over that 8-week period. So if you make, if you spend $20,000 on payroll for an individual person, that's 8 weeks out of 52. You need to annualize that over the course of the year, and then that would be limited to $100,000. So whenever you're deciding on whether to pay an employee a bonus or incentive payment, whatever it may be, consider this. This is where it's going to get you, is that limitation. Originally, guaranteed partner payments were not allowable as a payroll cost. That was, I guess, rescinded. Those amounts were excluded. Now they can be included. The interesting thing is the Treasury has said you can reapply for additional funding if this situation applies to you. I'm not sure whether the bank or the lender will allow that. Once they submit the documentation to the SBA, those loan amounts are typically set in stone, but those reportings are usually done on a monthly basis. So if you applied in this month, got paid, and they haven't reported it, you may be able to get more funding if you do have a partnership or any kind of LLC where you do have partner payments, partner compensation. For self-employed individuals, the loan amount was based on 8 weeks out of 52 years of the net profit on your 2019 Schedule C. That's limited to a net profit of $100,000 though, just like employee compensation is above. And that translates to $15,385 as a max amount of the amount that you can get. The costs for employees related to group health insurance and retirement are not included in that $100,000 payroll or that payroll amount. What that means is whenever you figure out the limitation on an individual's compensation, you don't pull in the benefits into that, the group and health insurance and retirement plans. That's strictly wages for that $100,000 compensation limitation. However, those amounts are included in the eligible payroll costs for forgiveness. I want to make that clarification so there's no confusion there. The limitation is only on wages, but the forgiveness amount and the 75% amount is all payroll costs. And then finally, originally when the CARES Act was issued, it talked about wages and independent contractors all being included in payroll costs. And pretty quickly, they realized that was a pretty big boo-boo, I think, and changed their tune on that and said that independent contractors are not considered a payroll cost, and they ruled those ineligible. They've stayed pretty firm on that. The general line of thinking there is for if an individual is an independent contractor of a company, that individual could apply for their own PPP loan, so they could almost double dip based on those wages. So the clarification was to limit that for the actual company that was paying the independent contractor. As far as the administration of these loans, the federal government has said they will audit all loans greater than $2 million, and then they'll randomly select other ones. So the way I envision it is anyone who received loans of $2 million, they're going to do something to audit those loans, and more than likely what they'll do is check the underlying support that's collected by the lender and make sure that it supports the amount of expenditures forgiven. But what they haven't said is what they will do as far as checking on that certification. So as far as greater than $2 million, what the government is going to look at to determine whether you were in need is still very, very blurry. As far as the others, they haven't said how they're going to select those loans to audit. They haven't given any indication whether certain industries will be hit harder than others. They haven't given any indication how many they'll look at, but they've just thrown that out there to say they'll look at others. A few various items about FTEs and hiring back employees. If the borrower has laid off employees, it doesn't necessarily have to hire back those same employees. It's a position for position thing. So if you extend an offer to a former employee and that employee doesn't accept it because they're drawing unemployment, they've gone somewhere else, it doesn't get held against you. It's just a position for position thing. Next slide, Michelle. So there's still a lot of questions that remain on the program, and tried to outline a few of the bigger ones here. What happens with that 8-week period for certain industries that still have not been able to open the doors, whether it's restaurants or gyms, whatever that may be, that they're at a distinct disadvantage whenever it comes to that forgiveness piece because they haven't been able to ramp up the expenditures to where they can get the full benefit of forgiveness. So I know that there's a lot of legislation out there currently in the mix. The legislators are trying to fight for you to extend that period. Whether that does get extended, I don't know, but that remains to be seen. There's still some question on cash or accrual basis of accounting. There's a lot of language out there that indicates one way or another. The CARES Act states costs incurred and payments made, whereas the Treasury rules say total amount spent over the covered period. Sorry about that. There just hasn't been any specific guidance on the definition of how to determine those expenses and how to determine what your pool of money is available for forgiveness. And then finally, as far as retirement benefits, they're eligible, but what isn't made clear is how much of that. Many small businesses don't make their contributions until one time in the year. They're discretionary. They may be profit sharing contributions based on how much money the company made. So there's a big question about this is a cost to us, and it is based on this 8-week period to a certain degree. So how much of that amount can we get forgiven? What we're recommended to people is take a look at what you've contributed over the past few years. If you're contributing 3% of folks' wages, but you don't make that contribution until very late in the year, go ahead and make a contribution, physically pay that amount during that 8-week period. Go ahead and make an estimate, whether it's 10%, 20%, 30%, whatever that is, just so that you can show good faith that if clarification comes out that it's going to be based on actual deposits, that you've made something. That way, at least, you have both ends of the spectrum covered, where they've earned it for the 8 weeks out of the 52-week period, but also you've made your best effort to fund a portion of that. So as far as the reduction of the forgiveness amount, as you know, there are some factors that reduces that forgiveness. Just to take a step back, over the 8-week period, you accumulate those costs, and there's eligible and ineligible costs. Once you decide what the eligible costs are, then we look at the number of employees that were retained. You're able to pick the period for your benchmark, so to speak. That can be during the period from same period between 2019, which is February 15th to June 30, 19, or it can be for the first 2 months of 2020. That's up to you. The employer chooses that time period. What wasn't certain was how do you calculate the full-time employee? And the application does provide a lot of color on that. Generally, full-time employees are going to be considered 30 hours per week or more. Now, there's some different alternative methods that you can use to calculate that. You can calculate spreadsheets based on a 40-hour work week, and if they work 30 hours, then it's 0.75, that type of thing. But they also give you the alternative of either you're full-time or you're not. And if you're not, then that full-time employee would be considered a half of a full-time employee. So there's some different ways to kind of simplify the process. You can actually calculate it out to the percentages, or you can kind of use a basic calculator of one full-time employee or a half full-time employee based on the hours worked. The reduction in compensation. The loan forgiveness is reduced by any employee's total pay that was reduced by 25% from the total in the most recent full quarter they worked. So if an individual was making on an annualized basis $100,000 a year, and due to just pay cuts and everything else, you ended up having to reduce that down to $70,000 on an annualized basis. There's $5,000 there that would be considered a reduction in compensation. Now, that wouldn't be on an annualized basis for the whole year, but it would be that same ratio for that 8-week period. Now, one thing to keep in mind, these reductions do not apply if the full-time employees are fully restored by June 30, 2020. If you hit those marks and you had 100 employees working during the payroll periods that you determined as your benchmark above, if you fully restored them, FTE, number of FTEs by June 30, 2020, those reduction amounts above that we talked about, they don't apply. There's a lot of words on these couple of slides, and I mainly put them up here just so that you would have the information available to you as some guidance. Basically, what the next 3 slides are, there's 3 things that you'll need to document as you get down to loan forgiveness. One is the payroll amount, the dollars. Another is going to be your full-time employee headcount. And then the third thing is going to be your non-payroll costs. For payroll, basically, you're going to have to document cash compensation and then the non-cash benefits from the covered period, or the alternative payroll covered period if you line your covered period up with the payroll payment period. Some of the items that they've specifically said will be needed in the application are bank account statements or third-party payroll provider reports. So if you use ADP, those annual reports there, or those quarterly reports, payroll period reports, whatever those may be, those could come into question. Your tax forms, your 941s, your state and quarterly business and individual employment wage reporting, unemployment, all of those payroll tax filings that you make on a quarterly basis. And then finally, any payment receipts, canceled checks, account statements, and the like that would support any kind of health insurance and retirement plan contributions. Those are all things that will have to accompany your application for forgiveness to support the payroll costs on your PPP loan. The next thing is to document your full-time employees. There's a number of different things that you'll have to support here. You'll have to support your benchmark period. You'll have to support your full-time employees as of the beginning of when you receive the PPP money, and then you'll have to document the FTEs as of June 30th. So there's a few different spots where you'll have to document the number of FTEs that you had. FTE, by the way, is full-time employee, just to make sure everyone has that. The information that they have suggested as part of the application is typically going to be the 941 and any individual employee wage reporting forms that you have. Anything that will substantiate the number of employees. So anything that's filed with the state, anything that's filed with the IRS, those are going to be considered very good supportable documents for this program. You know, if you receive your ADP report and it does show the number of employees, that's good. But whenever you translate that information onto an IRS form, there's a little bit more diligence that's done on that, and because there's penalties that could apply to you if you were to misstate that. So that's why they're probably going to rely on those federal forms. Next slide, Michelle. Finally, the last thing about documentation is on the non-payroll costs. Your mortgage interest, your rent and lease payments, and utility payments is the pool of costs there. Generally, for interest payments, they're going to want the lender amortization schedule. So whenever you have a loan, if it's over a 60-month period to pay that loan, there should be some type of amortization schedule that shows the amount of interest cost associated with each payment that you have. As well, they're going to ask for any receipts or canceled checks to document that you actually made those payments and didn't just forego those interest payments. Maybe the bank forgave it for a 2-month period because of the pandemic. Another one is going to be the rent and lease payments. They're going to want to see your current lease agreement because those leases should be effective as of February 15th, which is the start of this whole program. That's the date those leases should have been in place. If you obtained a lease after that, it's not going to be eligible. So they'll want to see a copy of the lease. They'll want to see a copy of your receipt or canceled check. And then they possibly might want to see some type of account statement from the lessor. And then finally, with the business utility payments, that's kind of a catch-all to a certain degree because there's plenty of utility types out there. I'm sure there'll be more guidance on what is allowable and what is not, but it can range from gas, water, electric, sewer to potentially gasoline for vehicles, that type of thing. What they'll want there is a copy of invoices, receipts, canceled checks, and account statements. Some of those things will be easily gotten, such as an account statement for utilities, but some things for any kind of fuel costs, those could be a little more difficult. Those may come down to individual receipts. Now, the next slide here, I'm going to allow or ask David to talk about this. This is another hot topic outside of the forgiveness and the PPP. These are some other things that you can take advantage of outside of the PPP if you need some additional incentives during the disaster. David, I'll turn it over to you.
Thanks, Mike. Sure, thanks, Michael. And I'd like to encourage people to ask questions in the chat if they have some, and then John's going to curate those and we can talk about those after I finish with this slide. I realize the bulk of attention and questions and uncertainties are surrounding everything that Michael just talked about, and even as he mentioned, even what we do know is potentially subject to change or undoubtedly will change in some regard when, if Congress moves something forward that modifies some of the existing parameters that we're working with. But I did want to mention at least one point beyond the Paycheck Protection Program, and this refers back to one of our prior presentations that I believe should be made available as well. where we touched on, in addition to the PPP opportunity, we touched on a number of the other tax-related benefits that accompany the CARES Act. If you're curious and you want to look back at that, those include the potential for Social Security tax deferrals for the rest of the year for employers. So you can't get out of it, but you can at least defer the employer portion of payroll taxes potentially through the end of the year and then pay that over the next 2 years. Also included the credits available for sick leave and family leave for people that are having to not work because either their children have to stay at home with them, or they are themselves diagnosed or quarantined by their doctor. And so we have a lot more information in one of the prior presentations on some of those items, in addition to some of the more tax-heavy topics, such as the ability to now carry back net operating losses for your business or yourself back 5 years and actually get potentially some cash refunds from actually when taxes were higher compared to where they are right now. And then also what I thought was applicable for this group was the enhancement of the depreciation on leasehold improvements. So if you have a building that you're operating in and you modify the actual building itself inside your lease agreement, as of a couple years ago and last year, that had to be depreciated over a pretty substantial period of time, 39 years. With the CARES Act, they finally modified and fixed the language in there to allow for it to qualified improvement property, QIP property, to be expensed immediately or allowable for bonus depreciation. And then lastly, we talked about the employee retention credit, which I mainly want to talk about or emphasize because this is if you either cannot receive the Paycheck Protection Program, or if you do receive it and then you actually pay it back. By when we made this slide by May 14th, it then got moved to May 18th. Where you had until you could refund the money, and then it would be as if you never went through the process in the first place. And some people, for some businesses, that might very well be because something like the employee retention credit allows them to get more money. This is a credit, so this is an absolute, this is not a loan, this is just money back, reduction of your taxes, where it's available to employers of any size. So unlike the Paycheck Protection Program and some of the other programs that limit it based on the size of the company or affiliate group, the retention credit is available regardless of size, including nonprofits. That's not really applicable here, but it does include tax-exempt entities. And it's a maximum of $5,000 per qualifying employee. That's basically 50% of the first $10,000 of wages during that period of time. So what's the catch? The catch is you have to you do have to be partially or fully suspended due to a government order, or be able to reflect a decline in gross revenues of 50%. And then the retention credit is only available for the duration of time that you are incurring that decline of gross receipts. And that is something that I imagine if they were to audit someone, you would have to showcase that you did either have the fully or partially suspension of operations, or you had a decline in gross revenues, which of course, if your doors are shut, is very easy to show. And in the quarter in which that is resolved, that's when the employee retention credit stops. But it is something that will allow, if you're keeping people on payroll and you've had to either shut down or massively take a step back, and you haven't applied for the Paycheck Protection Program, this is a way to get some decent returns. That can either be done through a payroll tax credit, or it can actually be done in advance of that if that's not going to get you as much money back as you otherwise would be entitled to. There's a Form 7200, which is a form that is created for the streamlined receipt of these types of credits, or you can correct a Form 941, even if this is after 2020 and you realize you would have qualified for it. Now in hindsight, you can still go back and get it. But again, just to reiterate, you can't double dip. You can't get the Paycheck Protection Program that allows for payroll to be provided to your employers, and then if that's the case, that employees, and if that's the case for a given, you can't do that and also get the retention credit But if you can't or choose not to go the PPP route, you can choose to at least consider seeing if you qualify for the retention credit.
Hey, David.
Yeah.
All right, we've got some questions here in the chat kind of piling up. So if you don't mind, I'm going to interject here and start reading you some of these. So, question. We have an employee that has not returned any messages for an offer of re-employment. How should we handle this?
I would, of course, there is no particular guidance on that, on the situation, but for me, I think you've tried to reach out. You've got that documented proof there. I would just keep those as part of that discussion. That seems to be support that that employee isn't coming back and would be excluded from your forgiveness reduction as far as restoring your full-time employees.
Okay, great. We've got question number 2. We had 11 employees in 2019, but we will need to reduce the amount of employees to 7 because of the amount of business we lost and continue to lose because of COVID-19. How long do we have to continue with 11 employees for loan forgiveness?
There's a little bit of confusion on that, and there is some unclarity. What the rule is if you restore your 11 by June 30, then there is no reduction. So what happens on July 1st? It seems to be who cares. It would be if you've met your 11 by June 30, then you're fine. What happens before then? If you restore it to 11 on June 15th and you reduce it down to 10 on June 20th, what happens? I don't know. They haven't really specified what happens and how you achieve restoration of your workforce. So a little bit of unclarity there. Hopefully that at least helped a little bit explain some of the thought process though.
Okay. And question number 3, the application itself does not state FTE is 30 hours. It states 40 hours.
You broke up a little bit there. Could you repeat that one time?
Sure. It says the application itself does not state FTE is 30 hours. It states 40 hours. So can you clarify the difference?
As far as the application go, when I was talking about the application, it's the forgiveness application that was issued on, I believe, Thursday or Friday of last week. And they have some worksheets included on that application for forgiveness that walks you through the calculation of full-time employees. And it does talk about 40 hours being full-time employee, but it also talks about some other methods to calculate it, and they give you some spreadsheets on how to walk you through that. So hopefully the application that was being referred to was not the forgiveness application, because I think it becomes much more clear if you take a look at that one.
Okay, great. And question number 4, are FTEs based on average per week or average per month?
That's another good question and not a lot of clarity. What we are doing is looking at it per pay period and averaging those out. So depending on your payroll periods, your frequency of pay, that's what I would look at and average those out.
Okay, thank you. And does CAM, C-A-M, and or sales tax paid on a business real estate lease an eligible expense? Is that an eligible expense?
I'm not sure on that one, but I wouldn't think it would be.
Okay.
I'm not sure how it falls into those categories.
So this was another question on the CAM. Can the payments be included in the rent category if it was paid during the 8 weeks, but are to pay 2019 CAM? So I think that's another CAM one. Question there. Hopefully we answered that one. If not, Addie, let us know, reach out. Next question, I only received 11,000 in PPP. One slide says I was eligible of at least 5,000 per employee. I currently have 14 employees. Can I present a supplemental PPP? Or can they do additional funds?
The 5,000 was with the employee retention credit, and that's a totally separate program. So you can't use both. So I don't think you can. Now, what the SBA has done is they have allowed applicants, because of the rule changes on guaranteed partner payments, they have opened up the application process to allow you to get more money if your calculation was based on rules that applied originally, and they have since changed and allow you to get more. They have allowed you to go back and ask for more money. The problem, though, is many of the banks have to submit those applications with the SBA, or all the banks do, and they usually have to do it on a monthly basis. There was a lot of questions about that reporting to the SBA. Once they report to the SBA, the amounts are locked in and you can't get any more funds. So SBA has extended that deadline for the lenders to submit those applications to the SBA. So if they have not submitted their application and you got your funding during this past period, you may be able to up it. So I would check with the lender. You know, if you only got $11,000 and you think you could get more based on the change in the rules, check with your lender and see. You may be able to up the amount.
Okay, great, thank you. Another one, we got, what do you do when your employees start calling in sick because they have a cough not related to COVID-19? They do not have sick time accrued.
Yeah, my understanding is that if we're talking about my reference to the paid sick leave credit, that would be if it's COVID related. And so if from an HR standpoint, if they don't have sick leave and they're trying to claim sick leave and they're admitting that it has nothing to do with their child staying at home because of government order, or that it is because they have any concerns about COVID related, that is outside the parameters of that credit.
Okay, perfect. Next question, what if we have reduced our part-time staff? They kept all their FTEs through June 30th. Do we lose the entire forgiveness or just the difference in payroll? So they reduced the part-time staff through June 30th. Asking, do they lose the entire forgiveness or just the difference in the payroll?
It's not going to be an all or nothing kind of thing there. It's going to be a ratio. So what you would do is convert those part-time employees into full-time equivalents. So just for easy math, let's say you have 2 part-time employees that work 20 hours a week. That's going to add up to 1 full-time employee. The forgiveness application does have some alternative methods to calculating full-time employees, and like I said, what they do is give it a grading system of 1 is for 40 hours or more, or 30 hours or more, I believe, and then 30 hours or less would be 0.5. So, and then you add up all of those to come up with your full-time employees. So they break it down into a very easy method, and then they give you some methods where you can actually, if you have the hours available, calculate it to the particular 100th decimal point kind of thing. Calculate it.
Okay, great. And next question here, for a healthcare provider, are PPEs a covered expense under the payroll protection loan? So they're a healthcare provider and they're wondering if the equipment that they're purchasing, the PPE equipment, a covered expense under the PPP loan.
I haven't seen anything that states that it is. You know, how does it fit into those categories of rent, utilities, interest? You know, it doesn't seem to fit. While required and needed, I haven't seen anything that says that it's allowable.
And let's see, if I received my PPP loan April 22nd, but my payroll close date is April 24th, 2 days later, therefore I have a gap in the 8 weeks to be paid, do I pay a bonus to make up for that few days missed, or just pay extra?
What I would probably suggest is start your 8-week period on April 25th. That's the alternative payroll covered period. That way the clock doesn't start until the start of that next payroll period, and then you count 8 weeks from there.
All right, perfect. And next question, where can I get a forgiveness loan application?
There's a hyperlink in this presentation, and I saw John said that he'll make it available, but if you go to treasury.gov and search for, or just actually search, Google search U.S. Treasury Paycheck Protection Program Loan Forgiveness Application, it'll pop up. It's about 7 or 11 pages. I can't remember. It's pretty lengthy.
Okay. Next question we have here, will we lose forgiveness if we increase wages in order to use the total we were funded within the 8-week period?
You won't, it's not an all or nothing forgiveness. If you increase your wages, but it stays within that $100,000 per employee limitation, then I think you'll be fine, as long as you meet all the other parameters, retaining the number of full-time employee head counts, that type of thing. You should be fine. But like I say on every presentation that we do on this, make a sound business decision. Don't use the money just to use it up, because at the end of the day, whatever doesn't get forgiven turns into a very, very low interest loan. So, and that money can help you push through this lingering thing if needed. So just use sound business sense. Don't try to just use it up because you can and you'll have to pay it back. You never, just like we've talked about today, the presentation I made last Thursday has totally changed from what it is today because they've changed the rules, and it's hard to budget and plan when the rules constantly change.
Okay, thank you, sir. Next one, can commissions be included as part of the payroll?
Yes, commissions can, but again, there is an annualization to it. If you pay a big commission during that 8-week period, it could possibly get limited if it exceeds the $100,000 on an annualized basis.
Okay, thank you. And can disability insurance be included in payroll expenses?
It is an employee benefit. I'm guessing it would be, but I don't have specifics on that one.
Okay. And I think you might have answered this one earlier. Can bonuses be included in part of the payroll?
It can, but like I said, it gets included in that wage pool. It gets annualized per employee, and it has to stay under $100,000.
Okay, great. Next question, how will we handle an employee who is now on non-COVID medical leave for the next several months? And by the way, they do not provide medical leave. So how do they handle an employee who is now on non-COVID medical leave for the next several months?
Not sure about that.
Yeah, I think that sounds more like a HR policy legal type question in terms of how you navigate those waters. If they're on medical leave, I know and I want to stay fully within at least our accounting and tax box here, but from my experience, that is something that would be maybe more of a human resource, maybe like even human resource legal question in terms of what your responsibilities are there as an employer. And if it's non-COVID related, then the tax credits that we mentioned earlier are not available.
Yeah, and also I'm just thinking through some of the criteria and hoops you have to jump through. You know, I would assume there would be some type of that the employee wouldn't be compensated during that medical leave, but yet they have a job when they come back. So I guess the question boils down to, are they still considered a full-time employee because they're employed but not getting paid? But then on the other side of it, if employees' payroll was reduced by more than 25%, then there is some reduction in the forgiveness amount. So you've got two conflicting things there. Even if they were included as a full-time employee, their payroll would have been reduced below that threshold, and it would be unallowed there. So I think it's going to be to be determined, I think, on that one.
Okay. And then next quick question here is, can you pay hazard pay?
Hazard pay has been questioned along the way, and I do believe it can be included in the wages. I've had a number of questions on that, and I've had research and ask others about that as well. But I think it can.
Okay.
Don't quote me on that one, but I think it can.
Okay. Can mileage expenses be included in payroll expenses?
I haven't seen anything that suggests that it can be.
Okay. I think you answered this one earlier about salary increases being allowed in the forgiveness equation, and I think you had already gotten to that one, that yes, it can, pending you stay in that 100,000 range. Yep. There. We have an employee who was full-time in 2019, but decided to go part-time at the beginning of 2020. Will this affect our loan forgiveness?
It could reduce the number of full-time employees, but you do have a choice of picking the same period, 2019, for your benchmark, like workforce numbers, versus the first 2 months of 2020. So take a look at both and see which one benefits you the best.
Okay. Sounds great. I think that's about all the questions we have. We've answered here. We've only got about 2 minutes left. So again, please look at your screen there and see the contact information. We've got the website and for Michael and David for Ingram. If there's another question you have, you can certainly reach out to John Stolp and myself, Crystal Lake, and contact us as well. And I think John's going to jump in here for a minute if he can.
Yeah, so we really thank Michael and David for joining us today here from CRI. We really appreciate all the information that you have provided for us today. You know, this is really the number one thing that our members have been asking us about is, you know, first of all, the PPP loan itself, and then once they got them, how do we get forgiveness on this? And as we've learned today from both of you, it is an ever-changing environment, and you know, we really need to continue to just watch the guidance that the Treasury and the Small Business Administration is giving to us. Yesterday we spoke when we were preparing again for today that we may have to have another one of these as things continue to change. So continue to watch your email for more information. I will be following up after this webinar with some additional documentation. This will be made available on our website for you all to review, as well as the presentation itself. Please don't hesitate to reach out to either of the presenters. You see their contact information on the screen. Don't hesitate to reach out to Crystal or I either. And we really appreciate your membership in the Florida Retail Federation, and we appreciate your attendance today. So thank you all for joining us. Have a great day.
Thank you, everybody.